Vamos ouvir agora as palestras exclusivas de dois profissionais de uma das principais gestoras do mundo, a Wellington, que tem mais de sobre gestão, $1 trilhão.
Gil, só uma coisinha que eu esqueci de falar, a gente vai ter uma interação que vai começar agora e depois das palestras da dupla da Wellington que a gente vai ter aqui, a gente vai trazer as respostas. A gente quer ouvir de vocês qual que é a ação, aliás, qual que é a música de rock que tem a ver com a ação que mais subiu ou caiu da sua carteira em 2020. Então usem a hashtag Melhores da Bolsa 2020 e coloquem lá qual a música que faz mais sentido com a ação da sua carteira. E aí depois das palestras da Wellington, a gente vai ver a resposta deles.
Boa, Salomão, você vai falar a sua também, né, depois?
Ah, com certeza, né?
Beleza. Bom, então vamos começar com mais esse painel internacional. A gente vai começar com a Nanette Jacobson. Ela é estrategista global da Wellington e vai falar sobre cenário e também oportunidades de alocação em diferentes mercados.
Welcome, everyone. So, remarkable, painful, unsettling, hopeful. These are just some of the emotions that we experienced in 2020. An absolute roller coaster, not to mention the economic and markets volatility we experienced this year. As the end approaches, COVID cases are spiking in Europe and the US. Fiscal stimulus in the US is on hold. And we've got encouraging vaccine data. So what will be the investment thesis for 2021? We ask the question for 2021, is the rotation for real this time? Over the 12-month horizon, we do think that vaccine news, policy support, and the gradual reopening of economies is the most important part of 2021. Those are the themes that will predominate, and it will mark a turning point, in our opinion, of the market's narrative. So we are taking a pro-risk stance over a 12-month investment horizon. And the big news is that having safe, effective vaccines will, in our opinion, be the catalyst for a durable rotation from growth to value-oriented exposures. Now, that's an umbrella for various types of exposures. In that, I would include non-US developed markets, smaller cap, and value. Within equities, we prefer Europe and Japan over the US in developed markets, and we think cyclical sectors are attractive relative to growth. I think rates will drift higher in this kind of environment because real growth is really beginning to take flight. And I do still find credit spreads attractive relative to government bonds. Now, as always, there are risks. On the downside, we are facing record highs in COVID cases and hospitalizations, and so that may result in further lockdowns in many parts of the economy in the world. And that is certainly a headwind and could put us in another recession. On the upside, we could get policy stimulus in the U.S. Once President-elect Biden takes office. So let me take you through a quick snapshot of our views. On the left-hand side, we've got the asset class. In the middle, my view of that asset class. And on the right-hand side, the most recent change that we've made to our view. So starting with developed market equities, you can see I'm moderately bullish. I am now neutral to U.S. Because that's the lowest beta equity sector, and we've already had a decent rise in that market. Of course, valuations are lofty too. So right now, I prefer Europe and Japan, and moderately bullish in both those areas. Europe has a lot of ground to make up. It's still down 10 to 15%, depending on the region. Japan is up, but both these areas have better valuations than the U.S. And you can see on the right-hand side that we took our weight down in the U.S. and increased our recommendation to Japan and Europe. In emerging market equities, we're actually neutral. This is kind of non-consensus because you would consider EM equities to be a value trade also. The reason is that China, which represents 40% of the index, already has experienced a tremendous rise in the markets, 25%, because China has handled COVID much better than the rest of the world. Now, for the rest of emerging markets, they've built up tremendous debt, and so we see more of a headwind there, plus the fact that the vaccine will take longer for it to be distributed in those parts of the world. As for 10-year government bond yields, we're moderately bearish. As I said, we do see growth starting to come through, and the U.S. has right now less capacity to buy all those government bonds than other regions in the world. And finally, in credit, we are neutral. Obviously, a rise in rates is going to be somewhat of a headwind, but it's rising rates for a good reason, which is that growth is better. So the areas that I favor are high yield, still bullish there, and also securitized assets. That's an area where the residential housing market, especially in the United States, is benefiting from both cyclical and structural changes. So this next slide just shows the extent of the sell-off that we experienced in March and how much that has retraced already. Obviously, in the safer areas in China, in communication services, in tech, we've seen at least 100% retracement from the lows. But you can see there are many other parts of the market that have lagged, and so we'd still see upside in those areas. You can see energy, high yield, financials, industrials. These are more value-oriented areas, and still they have not retraced fully from the lows. And these have been what are called the so-called COVID losers. Let's just look at the fundamentals globally, and you'll see on this slide that we have had actually a strong global rebound from the bottom in the second quarter, but there's still more work to be done. On the top, we have industrial production globally. Again, we've retraced the lows, but still more work to be done. And then maybe something that we can relate to more is the flights, global flights on the bottom panel, where we see the 7-day moving average actually has retraced about half of the downturn. But again, obviously, people are still reticent to get on planes, and plus business travel is way down. So more work there. If we can turn to the next slide, we'll talk about policy. So far, we've had a very strong fiscal response in the U.S., in Japan, and Europe. But the U.S. has been the bigger responder, at least up until now. And we do expect fiscal to eventually come, a fiscal stimulus, and that's why we had been favoring the U.S., but we expect that to rotate to Japan and Europe. And then on the next slide, we can see that monetary policy has also been very accommodative, and we still see that as a positive force across regions, even though the U.S. has been most aggressive. Now, on the next slide, we've got a picture that shows a vaccine update. We've had 2 companies also already report over 90% efficacy for this new technology, mRNA, which is a technology that's used for both these vaccines. And the fact that the efficacy rate is 90% or higher means that A, it's more effective, and B, people will be more confident in taking it, we hope. On the other thing is that distribution should be made easier. The most recent announcement has less restrictive rules in terms of its storage and distribution. So we are hopeful on that front. And our timeline is that by mid-year in 2021, much of the developed world will be vaccinated, although, as I said, emerging markets will take longer. On the next slide, we do have something that is, a downside risk, which is what will the take-up rate be for the vaccine? How many people will actually take it? And this is just a reality check that at the bottom you can see the U.S., France, and Russia, when asked the question, if a vaccine for COVID-19 were available and safe and effective, would you get it? And more than 30% of the population says they will not. get it. So that is still a concern, but we're hopeful that with the high effectiveness rate, people will be less concerned about that. Now, on the next slide, we want to take a look at this recent surge in COVID cases. And while devastating, we wanted not only to look at number of cases and number of hospitalizations, but normalize that to percentages. And we see that the COVID case rate is certainly at a peak, but the hospitalization rate has actually come down. And that is because we do have better treatments that are being applied since compared to March. Now, some supports for risk assets are on the following pages. First one is that we've got record cash on the sidelines. It amounts to almost 60% of AUM and money market funds. So we feel that this is a large amount of so-called dry powder for entering risk assets. People have been really concerned in putting their money into cash as a safe haven and to conserve any risk of sell-offs. On the consumer front, on the next slide, we have spending trends. And this is a tale of many cities. On the left-hand side, we see that the COVID losers, the areas that have been most vulnerable to COVID in airlines, cruise lines, movie theaters. We all know that those industries are in a terrible funk because of the disruption from COVID. But on the right-hand side, we see other trends that are more promising. We see that people are going on more road trips, and that's the top right-hand chart. They're fueling up and they're going to convenience stores. In the middle, we see gambling coming back, and that's an area that we do think will continue. And then home improvement. For all you do-it-yourselfers, we know that we're fixing up our homes, we're adding offices, and making our homes more livable, and that's been a bright spot. So with our data science team, who's collected over 300 million transactions from credit card and debit card transactions, we can spot these underlying trends and maybe pick these things up earlier than the rest of the market. Now, on the next slide, we wanted to give some historical proof of value outperforming growth. And what you can see is an analysis that looks at some factors. And on the bottom there, risk seeking, mean reversion, trend following, and risk aversion. Those are our own names for these factors at Wellington, but you can equate mean reversion to value. And what you can see is when we divide history, and that history starts in 2003, when we divide it into phases of the cycle, early, mid, late, and slow down, you can see that mean reversion performs best early and mid-cycle. And that's the point that I really want to get across today, which is that value should perform. We're still early in the cycle, early in the recovery. Markets are always anticipatory, even though Q1 may be difficult. And so value for both early and mid-cycle has, at least historically, proven to be the best performing factor. So let's look at valuations. And we've got U.S. equities, Europe, Japan, and emerging markets. We're looking at 20-year percentile rankings on a price to book and a Shiller PE basis. And the standout is that the U.S. is the most expensive. At the 97th percentile, that means that the U.S. market has only been more expensive 3% of the time. And we can see even relative to other regions in Europe, Japan, and EM, again, the U.S. is very, very expensive. Now, normally, we don't incorporate valuations very much into our framework, and that's because mean reversion can take years. As we have seen, value underperform for more than 10 years. So why do we think these other regions outside the U.S. are going to outperform now? The reason is that we have a clear catalyst, which is vaccines that are safe and effective, and we think that will change the market narrative and will be the catalyst to cause mean reversion to finally work. We're going to switch gears now and look at fixed income on the next slide. And people are very concerned about fixed income's ability to diversify risk. Understandable, yields are very low. But the work that we've done shows that when we look at the correlation between stocks and bonds, bonds are still negatively correlated to stocks, meaning when stocks go down, bonds go up. And that's what you see in this slide, that the correlation is negative, but you also notice that it is less negative than it used to be. The message is that bonds are not as potent as they used to be as a diversifier for risk assets like equities. Therefore, we do see a need to relook at your portfolio and see what else you might use to complement your fixed income exposure. Maybe it's making that more global, taking advantage of higher Chinese government bond yields, using some gold as a risk, as a hedge for possible inflation. These are areas, and even holding more cash, I do think is sensible, or at least short duration assets, to bulk up that hedging role of fixed income. Now, if we turn to the next slide, let's talk about credit. We'll look at valuations first, and you can see in the left-hand column that spreads in corporates, high yield, emerging markets debt, and mortgage-backed securities are around the 50th percentile, meaning that we're at about average levels in valuation terms. Now, in credit, mean reversion is much more reliable than in equities. So I'm satisfied that at the 50th percentile, credit will be a good performer in 2021. On the next slide, we look at default rates in high yield. Now, interestingly, default rates have actually come in lower than what was forecast in March. We see that default rates are around 8% right now, and they are forecast to peak at around 10%, but that is considerably lower than the peak default rates in prior recessions. So I find this encouraging news, and also feel that high yield is an area to continue to invest. The other reason that I like high yield is on the next slide. And this is showing fallen angels. These are companies that were investment grade but have been downgraded to high yield. Now, that fallen angel experience has been very good relative to the high yield index. And you see that in this slide, that fallen angels, a pure fallen angel index, has outperformed high yield. I think this is going to be a continuing dynamic. Investment grade debt leverage ratios are quite high, and I think the rating agencies are going to pick up their downgrades. That will be a benefit to high yield and active high yield managers for their high yield portfolios. Now, the next slide talks about structured credit, and another dynamic that we think will be durable even coming out of COVID-19 and the downturn we've seen in the economy, and that is U.S. residential housing. So obviously, we're experiencing a cyclical upturn in housing because people are moving out of apartments, they need more space. They may not want to be in densely populated urban areas. And so we're seeing this spike in home sales in single family. But I think the trend is more durable than that. And what this is showing is that we have a cohort of millennials that are just primed to buying homes. On the left-hand side, we see that once people get to the 35 to 44-year-old range, that population, there's a big spike in home ownership at that point. And then on the right-hand side, we also see the change in home ownership of 35 to 44-year-olds. This is the age range that millennials are just beginning to cross. And we think if they can get out of their parents' basements and buy a home, they're right at the tipping point to do so. And we know that supply-demand dynamics are really favorable for residential housing. I want to talk a little bit about currency and the weaker dollar. If we are, as I predict, going to be in a more risk-on mode, that means that the U.S. dollar will tend to weaken. And what we're showing is the dynamics there. When the dollar weakens, emerging markets do tend to do better. and also when the dollar weakens, cyclicals outperform. So we are, as I said, neutral in EM. We are recommending more exposure to cyclicals, but EM, our view is just because of this dichotomy of China and Asia already having done well, and the high debts that we're seeing in other EM countries. No strategy is complete without saying something about politics. So on this next slide, as we recorded this, President Trump was still not conceding his loss to President-elect Biden and had lawsuits in various swing states challenging the results. What I wanted to show in this slide is that right now, the Associated Press did call 306 electoral votes for Biden. And of course, 270 is the threshold for winning. What Trump would need to do is, even if he overturned two of the largest states where his margin of loss was biggest, he would still not get to the 270 votes. We would need at least 3 states to be completely overturned. So we don't see that as a likely scenario and do think that President-elect Biden's results will become official. On the next slide, something that won't change in this environment is a sense of protectionism, and that is specifically a tough stance on China. What this survey shows is that whether you're a Republican or a Democrat, there is real strong views on strong unfavorable views on China. So Trump, Biden, Democrat, Republican, it doesn't really matter. I expect that there will be continued restrictions on trade. With a Biden presidency, though, it will be done in a more multilateral way as opposed to unilaterally the way it was done in the past administration. All right, I'm just going to round up with another couple of slides. On this next one, it's more about strategic asset allocation and philosophy. What we want to do when we're constructing portfolios is not only think about the base case, but also think about the lower probability of cases in the event that I'm wrong, you're wrong, and our predictions just don't materialize. So having a balanced portfolio, diversifying across multiple economic scenarios is what I would advise. Here, we see that a recovery scenario would mean rising growth and still low inflation, and that is going to benefit the asset classes in that top left-hand box, which are most sensitive to a recovery. So equities, specifically non-U.S. equities, spreads, high yield, and those types of risk assets. Now, in case we're wrong, you do want to still have some fixed income exposure. What if we do have another recession? Well, that bottom left-hand box is suggesting that you have mortgage-backed security exposure, government bond exposure, high-quality municipal bonds, although I realize that doesn't apply to your portfolios. On the right-hand side, we have a case where inflation is rising, either with growth on the bottom right-hand, on the top right-hand side, or with stagflation in the red box on the right lower quadrant. And for that scenario, really what you want is exposure to commodities, things like natural resources and other commodities. And in the lower right, for an inflation scenario with slow growth, you want inflation-protected securities like TIPS or other inflation-linked bonds, and also precious metals. By saying that it's still a fairly complex landscape, investment landscape. We've got record COVID cases. We have hospitalization rates that are nearing peak limits. So this is very disturbing and could certainly delay the recovery that we expect. But for the full year in 2021, we are optimistic that with these more reliable results on the vaccine, that this really will, that we will see the light at the end of the tunnel. that we'll have a recovery in financial markets. Financial markets always look ahead of the economic fundamentals, and that will mean a durable rotation from growth-oriented exposures to more value-oriented exposures. Thank you again for listening. My name is Nanette Abuhoff Jacobson from Wellington Management. I hope that this is helpful, and best of luck and best health to you all.
Legal, pessoal. Ótima palestra da Nanette Jacobson, estrategista da Wellington. Ela fez um ótimo panorama do cenário global, falou sobre o crescimento de casos de Covid ao redor do mundo, mas também sobre a perspectiva positiva com a descoberta das vacinas, né, o surgimento das vacinas e o que isso significa para 2021. E também indicou algumas oportunidades de investimento em diferentes países e mercados. E agora a gente vai para a próxima palestra com John Boselli, que é um dos gestores mais admirados e bem-sucedidos do mundo. Ele é diretor da Wellington, responsável por um portfólio de ações, e vai falar sobre o seu processo de investimento e sobre os mercados onde ele enxerga as melhores oportunidades de compra de papéis de empresas de alto crescimento com qualidade. Então vamos ver agora o painel.
Today, I will discuss our investment philosophy and process and outlook for the global quality growth portfolio. In terms of investment philosophy, we believe alpha generation requires disciplined focus on 5 enduring attributes. First, we want to own companies that have high organic revenue growth. Most companies in the benchmark and the index, they grow their revenues about 3 to 4%. The average company in our portfolio grows their revenues organically at a rate of about 9 to 10%. And we're forecasting that growth rate over the next 5 to 7 years. The second attribute we look for are high quality business models. We measure quality in terms of the free cash flow generation as a percentage of sales. The average company in the index generates about a 9% free cash flow margin or return on capital employed globally. Our portfolio of companies generates about a 20 to 22% free cash flow margin or return on capital employed. So our companies in our portfolio are growing twice the rate of the market, generating about twice the quality of the average company in the index. Third attribute is we're looking for companies that trade at a low free cash flow valuation. Again, the market trades at about 24 times enterprise value to free cash flow on a 2022 basis. Our portfolio trades at about 23 times. So we trade at a slight discount to the market, yet we have twice the growth and twice the quality of the average business in the index. Fourth, we're looking for companies that have capital returns to shareholders, either in the form of dividends or stock repurchase. The market tends to generate about a 2.5% capital return to shareholders, and that's about where our portfolio is trading at as well. And finally, the fifth enduring attribute is we want to own companies with improving fundamentals. We measure fundamentals at the sector or industry basis and also at the company basis. We want the companies that we own in our portfolios operating in industries that are growing above average, and the companies that we're invested in are gaining market share versus the broad industry. Two characteristics that we believe are important. Our active share is about 75 to 80%. We believe high active share is necessary to generate consistent alpha. And also our downside mitigation is very important. Our downside capture is averaged about 75%. So we tend to do well in down markets. Our upside capture is averaged about 115% over time. So we've outperformed in down markets and in up markets. So our investment process is actually quite simple. It's about a 10-step process. The first step of the process is there's about 3,000 companies in our universe. In the first step of our process, we want to remove those companies that have low quality, that grow below average, that are too expensive, and that have poor capital allocation decision-making process. Now, in terms of quality, we remove from the universe any company that does not earn its cost of capital. So if a company is not generating an 8% return on capital employed or free cash flow margin, we'll tend to remove it. Secondly, we remove companies that don't grow organically, their revenues at least 3 to 4%, again, over the next 5 to 7 years. Third, we remove companies that are overvalued on a free cash flow basis. And fourth, we remove companies that have capital return issues. Either the balance sheet is over-leveraged or the quality is so low that they're not going to be able to pay a dividend to shareholders in the future. After this step of the process, we narrow the universe from 3,000 companies down to about 1,000 companies. These 1,000 companies, what we do is we build a forecasted model looking out 5 to 7 years, and we forecast the revenue growth of these businesses, the margin structure, the interest and taxes, the working capital and capital expenditures, and that forecasts a free cash flow rate and a free cash flow margin for all 1,000 companies in our universe. We push that information for each company into the database, and our system ranks those companies according to the best combination of quality, growth, valuation, and capital returns. What we do is we take those companies in the top half of the most attractive companies, and we go to the next step of the process. So at this point, we have about 500 companies left. We remove about 100 companies that we believe have negative fundamentals, and we measure fundamentals in terms of the revenue growth over the next 6 to 12 months, the change in the quality of the business, either the margins or the capital intensity, or the capital return is going to be changing, either increasing or decreasing based on the balance sheet and the cash flow generation. And after this step, we're left with about 400 companies. At this stage, we interview each of those companies. We interview the management teams, the CEOs, the CFOs, the head of the operations, and we ask them the same 20 questions each time we interview them. The questions are a combination of the growth of the industry or the sector. Again, we want to own and invest in companies that are outgrowing at the industry level. Then we want to know the company's expectations for revenue growth in terms of pricing and units sold. And then we're looking at the margin structure and the capital intensity of the business, again, over the next 5 to 7 years. And then we derive a free cash flow from those forecasts that we review with the management teams. At this point, we discount those cash flows back to present value for all 400 companies. At the end of this stage, we rate those company interviews 1 to 5. 1 is the best and 5 is the lowest. And what we do is we take those companies that were ranked 1s and 2s from our interviews and we go to the next step of our process. And that gets us to about 250 companies. At this stage, we get Wellington's 54 global industry analysts involved in our analysis. And the first step we go through is we ask them which sectors or industries in their coverage are most attractive. Either have accelerating growth or high growth, or the quality is going to improve, or the capital intensity is going to fall. And from this analysis, we can choose the top 10 to 15 most attractive sectors globally. We intersect these top sectors with the remaining 250 companies, and the output of that is about 150 high-quality growth stocks that have good valuation upside, good capital returns, positive fundamentals, and they operate in sectors in which we think are going to outgrow the market. The final step of our process is we show these 150 companies to the Wellington Global Industry Analysts, and we have a conversation about which of these companies are most attractive in their process. Which of these companies are buy-rated, owned in the sector or the research funds, have good fundamentals, good management teams, good capital allocation, and we believe have an above-average probability of outperforming the market over the next 3 to 5 years. From this step, we narrow this down to about 70 to 80 companies. And we buy those positions. Each position in the portfolio is actively weighted between 100 and 200 basis points above the index average. So that's the investment philosophy and process of the global quality growth portfolio. We also have a top-down element to our investment process, and we call this the Global Cycle Index. The Global Cycle Index is an equation. There are 7 variables in the equation. Things like industrial confidence, consumer confidence, employment levels, interest rates, interest rate curves, and M&A activity. Every month, our strategists estimate those 7 variables that is solved in the equation, and the output is a single number. Those numbers are plotted over time on a time series, and when those data points are upward sloping, when those data points are upward sloping, the global cycle index is improving, and when that global cycle index is improving, typically equity markets are improving as well. And higher growth, deeper valued stocks tend to outperform when that global cycle index is improving. In the opposite fashion, when the global cycle index is declining, typically equity markets follow those lower global cycle index readings. And typically when the cycle is declining, higher quality, higher dividend-oriented stocks are outperforming. And we tend to favor those stocks when the global cycle index is declining. I would say about 70% of the time, we are equal weight all 4 factors of growth, quality, valuation, and capital returns. And about 30% of the time, we're either overweight growth and value or we're overweight quality and capital return to shareholders. And this positioning of the portfolio gives us very good downside and very good upside capture. So the outlook for global equity markets is on stable footing today. Entering 2020, the global cycle index was actually improving, and we had anticipated growth to inflect positively in January and February. The spread of the coronavirus halted all economic growth as governments slowed activity in attempts to contain the virus. At that point, we shifted to an overweight of quality and higher capital return to shareholders, and we underweight growth and valuation in March, April, May, and June. Once governments started to stimulate both fiscally and monetarily, the economy tended to recover. That stimulus got to about 10 to 12% of GDP, which is the highest rate of stimulus since the 1940s. Global central banks were purchasing assets out of the market of nearly $1 trillion across the globe. That's 6 times the monthly peak in 2016. And what this has done is it's compressed market volatility and bond yields. Today, the global cycle index is improving from very low levels, but the gains are fairly modest, and the level remains substantially below pre-COVID levels. Central banks are committed to another wave of global liquidity into 2021, and we believe this will be led by the ECB. The 2021 economic recovery we have forecasted at 4% of GDP growth. Now, most importantly for our economic recovery is a vaccine. And there are a number of vaccines that are working its way through the phase 3 process, and we're expecting to hear news in December. The Pfizer vaccine is the most promising vaccine. Their efficacy is about 90%, which is very efficacious in the industry and history of vaccines. Pfizer has committed to 50 million doses by year-end 2020 and another billion doses during 2021. In terms of the political situation, President Biden has won the White House, and Democrats, they've kept the House. They lost a few seats, but the Republicans have kept the Senate. So we think this implies that President Biden will most likely govern from the center. No Supreme Court packing, no big tax increases, no big changes to healthcare regulations. And we believe this is good for pharmaceutical companies, healthcare companies, technology companies, e-commerce companies, and especially housing. The housing industry should be benefiting as President Biden has a positive, affordable home ownership plan in place. On a regional basis, we are overweight North America and China, North America by about 7%, and China by about 4%. In North America, the fiscal and monetary stimulus has been very effective, nearly 10% of GDP. We have been trimming recently on valuation, but North American companies are dominated by these technology powerhouses offering enterprise services, cloud services, semiconductors, and e-commerce businesses. In China, we're also overweight. They've been ahead of virus containment, and the cycle is accelerating in China. Last month, their GDP growth was 4.9%, and we're anticipating a 2021 economic growth rate of about 5 to 6%. The PMI in China is about 55 to 56, which is the highest they've recorded since 2011. What's happening in China is the per capita GDP has increased beyond $10,000 per person. Once most countries hit this $10,000 per capita GDP rate, the amount of discretionary spending tends to increase at a rate of about 7 to 8%. And that's very good for consumption of consumer, retail-oriented items, and also healthcare. And so we're overweight North America and China in our portfolios. Our biggest underweight is Japan. Governments have the Japanese government has the fewest measures in their toolkit, as rates are already negative, and government debt to GDP is nearly 200%. Their COVID economy has been damaged. There has been enormous public debt, and that has surged even further. Consumer confidence is weak in Japan, and their aging society and shrinking population has impacted economic growth. So we remain underweight Japan. Now, on a sector-wide basis, across the portfolio, we are most overweight information technology, roughly 12 to 13% overweight information technology, and about 5% overweight consumer discretionary. Our biggest underweights include financials at 6%, and we're underweight consumer staples at 5%. Materials and utilities are underweight about 3% each. So we're overweight to technology, consumer discretionary, underweights in consumer staples and financials. At the industry grouping level, our biggest overweight is software and services, which has been true for some time, and also semiconductors and semi-cap equipment. The 5G infrastructure build out in Asia Pacific, Europe, and North America will drive semiconductor chip demand. Also, the data center cloud service businesses is a large consumers of semiconductor and semi-cap equipment across the world. Our largest overweight are banks. The issue that we have with banks is interest rates are very low, and that impacts the net interest margin and the earnings power of these banks and the quality of the businesses themselves. So on an industry basis, we're most overweight software services and semiconductors, and our biggest underweights are the banks. In conclusion, I'd like to thank all of you for your attention and the opportunity to manage your clients' capital. We take our fiduciary responsibility very seriously, and we hope you have a nice day. Thank you.